Women are about to inherit the world. That is not an exaggeration. $105 trillion is expected to change hands by 2045, and women are expected to receive more than half of it. That sounds like good news. And in many ways, it is. But money arriving is not the same thing as preparedness arriving. And for a shocking number of women, this wealth transfer could become a financial crisis instead. I'm Mila, and I want to talk about what this moment actually requires from women before the money ever arrives. We are going to look at the real risks, the readiness gaps, and what it actually means to be prepared for wealth instead of simply expecting it. And I made a free wealth transfer readiness checklist for this video. I'll share it with you at the end. Now, let us get into it. UBS has been tracking this shift closely through their Own Your Worth report, and the numbers are not small. Baby boomer women alone are expected to assume control of $40 trillion simply by outliving their spouses. Add inheritances from parents, estate transfers, and the broader generational handover already underway, and what you are looking at is the single largest movement of wealth toward women in modern history. Financial experts have been calling it a once-in-a-generation correction. And honestly, it is long overdue. So yes, the headline is real, the scale is real, and it matters enormously. But here is what that same UBS research found when they looked past the headline. And 80% of women who have already been through a wealth transfer, whether from a parent or from a spouse, face significant challenges when that moment actually arrived. 80%. That is not a small outlier group. That is the overwhelming majority of women who have already lived through the exact moment this headline is promising. And that number does not exist because women are incapable. It exists because too many women are walking toward this wealth transfer without the communication, the visibility, the planning, or the operational knowledge they actually need. Not because they did not want it, but because too many of them were never fully brought into the conversation in the first place. That is what this video is really about. The risk is not that wealth is not coming to women. The real risk is that it may reach many women before readiness does. Hold on to that. Because that is the thread running through everything we cover today. A transfer of wealth is not the same thing as a transfer of preparedness. Wealth can move in a single legal event: a death, a signed document, a court process. Preparedness is built over time, through visibility, through conversation, through understanding, through structure. One can happen without the other. And when it does, what was supposed to be a turning point becomes something far more complicated. So let us get into exactly how and why that happens, and what you need to have in place before it does. Section 2. Before we go any further, I want to say something directly. You may be watching this and thinking, this does not apply to me because I'm not expecting an inheritance anytime soon. I want you to stay with me anyway, because this conversation is not only for women who are actively waiting on wealth to arrive. It is for every woman who may one day receive assets from a parent, assume financial control after losing a partner, or pass wealth down to children of her own. It is for every woman currently in a partnership where financial visibility is already a quiet question. Wealth moves in every direction, toward you, through you, and beyond you. And the woman who understands how that movement works is the one who stays protected, no matter which direction it comes from. Now, let us get into the full picture. The scale matters because it tells you how high the stakes really are. This is not one woman inheriting a modest sum from her parents. This is a generational event. The baby boomer generation accumulated more wealth than any generation before them, through real estate, through decades of investing, through businesses built and held over lifetimes. And that generation is now aging. They are passing assets to spouses, they are leaving estates to children. They are transferring financial control in ways that are accelerating every single year. UBS found that many women will not experience this once but twice. First, when parents pass assets down. Then again, when they outlive their partners and assume full control of household wealth. Two transfer events. Two separate moments where readiness either shows up or it does not. And because the window between wealth arriving and the decisions that follow is often very short, because there are legal deadlines, financial structures already in motion, and systems that do not pause for grief, readiness cannot be built after the transfer starts. It has to exist before. So let us talk about exactly where that readiness breaks down. Gap 1 is communication, and the financial damage it causes starts before the money ever moves. Nearly 1 in 3 women who inherited from a parent had no prior conversations with them about the transfer before it happened. None. They went from not knowing to suddenly being responsible, with very little in between. And I know why this happens. Talking about death and inheritance in most families still feels uncomfortable. Parents avoid it because they do not want to seem like they are planning to die. Adult children avoid it because they do not want to seem like they are waiting for money. And so everyone stays quiet, and the silence feels fine until it is not. But here is what that silence actually costs in real financial terms. When there has been no communication, the woman stepping into that transfer does not know what accounts exist, who the advisors are, what the intentions were, or whether any of it was structured properly. And because she is also grieving, she is making financial decisions, often irreversible ones, without context, without guidance, and without time to think. Assets get moved too quickly. Accounts get closed before their tax implications are understood. Advisor relationships get continued by default because there is no energy to evaluate them. And decisions made in the fog of those first 90 days can cost hundreds of thousands of dollars that no amount of clarity later can recover. Silence is not neutral. In the context of wealth transfer, silence is a financial risk with a very real price tag. Gap 2 is planning. And the dangerous part is how easily people confuse intention with structure. 4 in 10 women who inherited from a parent did so without any wealth transfer or estate plan in place. No will, no documented instructions, no clear structure for how assets were meant to move. Just a general assumption that things would work themselves out when the time came. And I understand how this happens. People know they need a plan. They intend to get one. Life stays busy. The conversation keeps getting pushed. And in the meantime, the default assumption becomes, there will be money. And when the time comes, we will figure it out. That feels like a plan. It is not. Because here is what no plan actually costs. Without a will, assets go through intestate succession, meaning the state decides how they are divided, not the person who built them. That process can take months. In contested situations, it can take years. And while the estate sits in legal limbo, the bills attached to it do not pause. Property taxes still arrive. Maintenance costs still accumulate. Insurance still needs to be paid. The woman waiting on that inheritance is not just waiting on money. She is potentially absorbing costs on assets she does not yet legally control. I add to that the family dynamics that surface when there are no clear instructions. And you have a situation where grief, money, and unresolved relationships collide at the worst possible time. Legal disputes between family members over an undocumented estate can consume tens of thousands of dollars in legal fees, money that comes directly out of the estate before anyone inherits a single dollar. There will be money is not a plan. A plan has documents, a plan has structure, and a plan exists before it is needed. Gap 3 is visibility. And this one is quieter than the others, which is exactly what makes it dangerous. About 1 in 3 women expecting to inherit from a parent have no idea where their parents' assets are located, how they will be divided, or whether a plan exists at all. They know in a general sense that there is wealth. But they do not know what form it is in, where it lives, who manages it, or how it is structured. They are financially adjacent without being financially informed. And this is not only a parent-to-child issue. In many partnerships, one person tends to manage the financial mechanics, the accounts, the investments, the insurance policies, the advisor relationships, while the other stays aware at a surface level without going deeper. It feels fine inside a functioning relationship, but it creates a visibility gap that becomes critical the moment circumstances change. Think about what lack of visibility actually costs. A woman who does not know what accounts exist cannot locate assets quickly. Assets that are not located within a certain window can be turned over to the state as unclaimed property, and reclaiming them is a frustrating process. A woman who does not know how assets are titled may discover that an account she expected to inherit was structured in a way that sends it somewhere else entirely, because beneficiary designations override wills, and she did not know that. A woman who does not know who the advisors are cannot evaluate whether those advisors are acting in her interest after a transfer. She inherits not just the assets, but the relationships, the fee structures, and the decisions already in motion, without a clear baseline to judge any of it. The money can exist. The intention can exist. And a woman can still find herself standing in the middle of a financial transition with no real map of the territory she is now responsible for. Gap 4 is what actually happens during the transfer itself. And this is where the headline most completely falls apart. More than half of women who have already been through an inheritance uncovered a financial surprise during the process. More than half. And I need to stop here and actually explain what those surprises look like, because this is the section most people gloss over. And it is the one that does the most damage. The biggest surprise is almost always tax. And I want to break this down in plain language because this is genuinely one of the most misunderstood areas in personal finance. First, estate tax. If the estate being transferred is large enough, the IRS may take a portion of it before a single dollar reaches the heir. The federal estate tax basic exclusion amount for 2026 is $15 million for estates of decedents who die during 2026. So most people will not hit it at the federal level, but many states have their own estate taxes with much lower thresholds, some as low as $1 million. A woman inheriting a modest home in a high-value market, plus investment accounts, plus life insurance proceeds, can cross that threshold faster than she expects. And if she does not know this in advance, that tax bill can arrive before she has liquidated anything to pay it. Second, capital gains on inherited assets. This is where the step-up in basis rule becomes critical knowledge. When you inherit an investment or a property, the cost basis, the original purchase price used to calculate your gain, is stepped up to the value at the date of death. This is one of the most valuable tax protections in inheritance law. But it only protects her if she understands it and acts accordingly. If she sells quickly and without guidance, she may leave significant tax protection on the table. And if assets have already been moved or restructured incorrectly before she gets involved, that protection can be lost entirely. Third, inherited retirement accounts. This one blindsides more women than almost anything else. If you inherit a traditional IRA or a 401k, that money is not tax-free. Every dollar you withdraw from an inherited retirement account is taxed as ordinary income in the year you take it out. And under current rules, most non-spouse beneficiaries are required to fully withdraw inherited retirement accounts within 10 years. Depending on her own income level, pulling those distributions incorrectly, too much in one year, not enough in another, can push her into a significantly higher tax bracket and cost her tens of thousands more than necessary. Fourth, probate costs. Probate is the legal process through which a will is validated and assets are distributed. It is not technically a tax, but it functions like one. Attorney fees, court filing costs, executor fees, and administrative expenses during probate can consume anywhere from 3 to 8% of the total estate value. On a $500,000 estate, that is up to $40,000 gone before she touches a dollar. On a $1 million estate, it is potentially $80,000. And if the estate was not structured to avoid probate, through trusts, through proper titling, through beneficiary designations, that cost is unavoidable. Now add these together. A woman who did not know the estate tax thresholds in her state, who sold inherited investments without understanding the step-up in basis, who pulled her entire inherited IRA in 2 years because she did not know about the 10-year rule, who paid full probate costs because there was no trust structure in place. That woman did not just receive less than she expected. She may have paid hundreds of thousands of dollars more in taxes and fees than she ever needed to, simply because nobody explained the mechanics before the transfer happened. This is why more than half of women said they were shocked, not because the system was dishonest, but because the system is complicated, moves fast, and does not explain itself to people who were never brought into the conversation. Now, here's the layer the data alone does not fully capture. Why does this pattern hit women so consistently and so specifically? This is not about capability. Women manage complex finances every day. Women run businesses, manage households, negotiate contracts, build portfolios. Capability is not the variable. The issue is exposure. There is a pattern that shows up across generations and income levels where women are present for the lifestyle that wealth creates, but not always brought into the mechanics that govern it. Advisor meetings that happen without them. Estate planning conversations they were not included in. Financial decisions made on behalf of the household that were never fully explained. Not always out of malice, often out of habit. Out of the assumption that the details were being handled and that was enough. There is also what researchers call the caregiver penalty. Women disproportionately step back from professional and financial life at key moments. To raise children, to care for aging parents, to support a partner's career. And while that caregiving is happening, the financial exposure that builds visibility, literacy, and decision-making confidence is also slowing. So by the time a transfer event arrives, Many women are approaching it with less operational familiarity than their partners had, not because of who they are, but because of how their time and attention were directed. The result is a woman who is financially adjacent for years, present for the outcomes, removed from the mechanics, and then suddenly asked to be fully in charge of both. And nothing makes that reality sharper than what happens when a woman is widowed and inherits full financial control of a household she was only partially inside. This is the most concrete version of everything we have covered. A woman loses her partner, and in the middle of grief, in the middle of one of the most destabilizing experiences a human being can go through, she is suddenly responsible for a financial system she may not have had full visibility into. Accounts she did not manage, investments she did not choose, advisor relationships that were primarily her partner's, tax decisions that need to be made on timelines that do not accommodate loss. UBS found that the majority of widows said their partners did not have a wealth transfer plan in place, which means these women were not just grieving, they were also building financial clarity from scratch, in real time, under enormous pressure, about a financial life that was partially invisible to them before loss made it suddenly and entirely their responsibility. And what tends to happen in that moment, when emotional weight is highest and operational clarity is lowest, is that decisions get made reactively. Advisors who should be evaluated get trusted by default. Assets get moved without understanding the tax consequences. The 10-year IRA clock starts ticking, and she does not know it. And the woman who was supposed to step into financial empowerment instead finds herself financially exposed at exactly the moment she is least equipped to handle it. This is not a rare story. This is the majority experience of women who have already lived through a wealth transfer event. And the only thing that changes the outcome is whether readiness arrived before the money did. Section 3. So let us talk about what readiness actually looks like, because everything we have covered in this video is not meant to frighten you. It is meant to wake you up early enough to do something about it. The women who navigate wealth transfer well are not smarter than the women who struggle. They are not more financially gifted. They are simply more prepared. And preparation is not mysterious. It is a set of specific, concrete actions that anyone can take. And the best time to take them is before you ever need them. So let's look at the 5 things that genuine readiness actually looks like. The first is getting into the room. Before anything else, you need to be in the conversation. If your parents have wealth, a home, investments, retirement accounts, a business, anything, and you have never had a direct conversation about what happens to those assets, that conversation needs to happen. I know it feels uncomfortable. I know it can feel presumptuous, but reframe it. You are not asking about the money. You are asking about the plan. You are telling your parents that you love them and you want to be prepared to honor their wishes properly when the time comes. That framing changes the energy of the conversation entirely. The same applies inside your partnership. If your household has assets, accounts, property, investments, life insurance, and one of you is managing the mechanics while the other stays at the surface, that needs to change. Not because something is about to happen, but because financial visibility inside a partnership is not a luxury. It is a responsibility you both carry. Get in the room, ask the questions. And if someone tells you not to worry about it, that is exactly when you should worry about it. The second is knowing what exists. Not generally, specifically. There is a big difference between knowing that your parents have investments and knowing which brokerage holds them, what the account numbers are, and how they are titled. There is a big difference between knowing your household has life insurance and knowing the policy number, the carrier, the coverage amount, and who the named beneficiaries are. What you are building here is essentially a financial inventory. And it does not need to be complicated. It needs to cover the following ground. What bank and investment accounts exist, and where are they held? What property is owned, and how is it titled? What insurance policies are in place? Where is the will stored? And when was it last updated? Who are the named beneficiaries on every account that has one? Because remember, beneficiary designations override the will entirely. And what debts or liabilities are attached to the estate? You do not need to manage any of this. You just need to know it exists and where to find it. Because the woman who walks into a wealth transfer event with that inventory already in her hands is in a completely different position than the woman building it from scratch while grieving. The third is understanding the structure, because how assets are held is just as important as the fact that they exist. This is where a lot of women get surprised, and it is completely avoidable. Assets held in a trust transfer differently than assets that go through probate. A retirement account passes to whoever is named as beneficiary, regardless of what the will says. A jointly owned property with right of survivorship transfers automatically to the surviving owner. A property held only in one person's name goes through the estate process entirely. Understanding the structure means knowing which of your family's assets fall into which category. It means knowing whether a trust exists and what it covers. It means checking that beneficiary designations are current, because a beneficiary named 20 years ago on a retirement account is still the legal beneficiary today, even if circumstances have completely changed. I have seen situations where an ex-spouse received an inherited IRA because nobody updated the beneficiary designation after a divorce. That is not a hypothetical. That happens. You do not need to be an attorney to understand this. You need to ask the right questions and involve the right people. Which brings us to the next point. The fourth is understanding how transfer actually happens, the mechanics, the timeline, and the tax implications. You now know the basics from what we covered earlier in this video. Estate taxes vary by state, and the thresholds matter. The step-up in basis is one of the most valuable protections in inheritance law, and it only works if you understand it. Inherited retirement accounts come with tax obligations and distribution rules that require active management. Probate costs are real, and proper structuring can eliminate most of them. But understanding the mechanics means going one step further than knowledge. It means having a conversation, before any transfer event, with a tax professional or estate attorney about the specific assets involved. Not a general conversation, a specific one, because the tax strategy for an inherited IRA is different from the strategy for an inherited brokerage account, which is different again from the strategy for inherited real estate. Generic awareness is not enough. You need situation-specific guidance built before the transfer happens, not assembled under pressure after it does. The women who walked away from their inheritance in the strongest financial position were not the ones who got lucky. They were the ones who understood what was coming well enough to make deliberate decisions rather than reactive ones. The fifth is building your advisory bench. Because you should not be navigating any of this alone. One of the clearest patterns in the UBS research is that women who had professional support in place before a wealth transfer event fared significantly better than those who were building those relationships in the middle of one. And I want to be specific about what that bench actually looks like. You need a financial advisor who understands wealth transfer and works in your interest, not just the interest of the estate or the existing family relationship. You need an estate attorney who can review existing documents, flag gaps, and help you understand what you are actually looking at when legal paperwork arrives. And you need a CPA or tax professional who understands the specific tax implications of the assets you are likely to inherit. These do not all need to be active relationships you are paying for monthly, but they need to exist before you need them urgently. Because finding a trustworthy financial advisor in the middle of grief, while simultaneously making irreversible decisions about inherited assets, is one of the hardest positions you can be in. The advisor bench gets built in calm, so it is ready in the storm. If you are not sure where to start, the checklist in the description walks you through exactly what to look for and what questions to ask each type of professional. Use it. And here's the final truth I want to leave you with. Wealth alone does not create safety. That is the line I need you to carry out of this video. $105 trillion is moving. Some of it is moving toward you, and the fact that it is coming is not enough. What creates safety is not the arrival of money. What creates safety is visibility, voice, structure, and preparedness, built before the money ever moves. The women who will be truly empowered by this wealth transfer are not just the ones it reaches. They are the ones who were ready when it arrived, who were already in the conversation, who already knew what existed, who already understood the structure and the mechanics and the tax implications, who already had people in place to help them make clear decisions rather than reactive ones. That woman does not get blindsided. She does not lose $40,000 to a probate process that proper planning would have avoided. She does not pay an unnecessary tax bill because nobody explained the step-up in basis. She does not hand her financial future to an advisor she never vetted because she had no energy to do otherwise in the middle of grief. She steps into that transfer informed, supported, and in control. Not because she was lucky, because she prepared. The wealth transfer is coming. The only question is whether your readiness is coming with it. And if you are not expecting an inheritance, if you are the one building from scratch, laying the foundation, creating the wealth that will one day move forward, this still belongs to you. Because the woman who understands how wealth transfers is also the woman who structures her own assets correctly, protects what she builds, and ensures that what she creates actually reaches the people she intends it for. Readiness is not only for receiving, it is for passing forward too. So start now. Have the conversation, pull up the checklist, ask the questions you have been putting off, because the best time to prepare for a moment like this was years ago, and the second best time is today. You deserve to receive what is coming to you, or pass forward what you have built, with clarity, with confidence, and with your finances fully in your hands. And always remember, luxury is easier when your money is organized. I will see you in the next one, and I love you.